There's a saying by Warren Buffett that says it's only when the tide goes out that you can see who's been swimming naked. So when we consider operators and we consider multifamily investing, why is it important to look at what separates the strong ones from the weak ones? So with me today, I have Michael Blanc, the CEO of Nighthawk Equity. Welcome, Michael.
Hey, Bronson, great to be here.
Really good to have you. So can you answer that question? Why is it important? What separates strong operators from weak ones?
Yeah, this is the time we're going through right now is going to demonstrate who's swimming naked and who isn't, right? And unless you like that kind of thing, that would be good. But normally, I guess it will be bad. So it's going to differentiate the strong operators from the weak ones. And over the last 5-6 years, because the market's been going up, it's really covered up all kinds of sins and things, and it's really difficult to screw things up when the market keeps going up like it has. And now we're going to see things go flat, maybe down. People are going to run out of cash, and we will see some of the strong operators kind of be weeded out from the weak ones from the strong ones. And so some of the things is it really comes down to this. I mean, fundamentally, it comes down to the team. Yes, it's track record. We'll talk about that, but it's really the team. Who are the people on board that are in this team, and what is their makeup? What is their individual stories? To what degree have they maybe gone through some loss, suffering? Have they experienced a recession before? Because I'll tell you, I've gone through the last recession. I lost basically my entire net worth through that, and that changes you, and it really positions you for something like this when you have perspective on something, and it actually leaves you a lot calmer than you would otherwise be, because otherwise you'd be freaking out. Oh my gosh, tenants aren't paying, or we're going under. And then you start making really stupid decisions, or worse, you freeze in paralysis. So what is the makeup of the team? Who are those team members? What is their stories? What are their backgrounds? And then number two is track record, right? I mean, what have they done? What have they done? What kind of successes have they had? Maybe what kind of failures have you had? Again, I'm a big believer in failures and challenges, because that's when you really learn things. Well, what kind of challenges have they been through? What kind of storms have they weathered? What happened? How did they fare? How did they behave? Did they do the right thing? Did they just try to save themselves? So what is their track record? What have they done? Then the second is really, well, how conservative are they with regards to their underwriting? And this goes back to, how did we all get into these deals 2 years ago, a year ago, right? Did we maybe cut some corners? Did we maybe, sandbag our projections a little bit so we can get the deal done? Well, that's going to come out now. And so how conservative were underwriting assumptions? Because there's so many, operators out there who put a deal out with a 17% IRR and a 12% cash on cash. And the unknowing investor just gravitates towards the higher return, not asking, well, how'd you come up with that number? What assumptions are you making? Oh, you're using a lower cap rate at exit? First of all, that implies, well, you should probably know what that means. See that all the time. Oh, there's no reserves at closing? There's no reserves while you're operating? And you're projecting $150 per month rent bump in year one? Well, all these things, right? If little tiny changes like to make a humongous difference in the return. So you have to be conservative in your underwriting. And then the biggest thing is, this is one of the main lessons I learned in the last recession, is you cannot run out of money. So when you get into a deal, you have to have enough money at closing for unforeseens in the first 6 to 12 months. And then you have to retain money in cash so you can handle emergencies, so you can take care of capital reserves, repairs, and things of that nature. So you never want to run out of money. And that's going to be, right now, is going to be that key differentiator. People who have been running thin up to now are going to be really tested. And people who have been following best practices, procedures like I just talked about, well, they're going to be fine. We may not distribute money for a quarter or two just to be on the safe side, but we're going to be just fine. And so we're going to see some bubble to the top, and some, we may be buying their property soon.
So, that quote from Warren Buffett about swimming naked, and obviously, as you're a passive investor and operator, it's not good to be naked, because that means you typically have losses, or the returns are not what they should. So what's an example of a weak operator, how things can go wrong?
Well, we talked about things that are, that they would do otherwise, that they would not do. And certainly making aggressive projections is one of those things. And the result of that is that they're not going to make the cash and the valuation that they've projected. And so, in best case scenarios, their investors are not going to get the profits that they projected. Worst case, it gets worse than that, and they start losing money, right? Their occupancy is lower. They never actually get to their target rents because they projected them wrong. There's a variety of things that can go wrong in a cash crunch, like we could be potentially in, where maybe the income could be down, right? So what kind of cash cushion do you have to ride that out? Well, if you had cash to distribute beforehand and you just simply stop distributing it, it's no problem, right? So the investors are not going to lose their capital; their value is preserved. It's not like they're losing a third of their or half of their wealth like they did in the stock market. It's just they can't cash a check for maybe a quarter or two, but their wealth and their principal is still safe. So a good operator has multiple safety nets built in all the way down, and the not so good operators do not have those same safety nets, and that's the issue. So the worst thing that can happen is they run out of cash, right? I think a perfect example: sewer pipe breaks, right? Affects 2 buildings in the property. Cost $30,000, $40,000 to fix. Well, the operator, because they really haven't been making a lot of money, or maybe they distribute as much to kind of make up for, to make their investors happy, don't really have the cash to fix it. And now what are they going to do? They can't fix it. So now their tenants, what are they going to do? They're going to move out. Now their income goes down even further, and it's a downward spiral. Where's that going to end? Without a cash infusion, it's not going to end well. I can tell you that. Versus the operator who has the cash in reserve because they had it at closing and they've been taking it out of cash flow. Well, it's not good to spend $40,000 on a sewer pipe fix, okay? And that's going to really depress my returns. And maybe my investors aren't going to be happy that they can't get the same distribution they're expecting. But at the end of the day, we're going to coast right through it. And in our 5-year long-term hold, it's going to be just fine.
So, Michael, I've come to believe whether you're whoever you are, whether you're a passive investor or you're an operator, a growth mindset is very important to continue to grow and develop, as a person as well as an operator or as an investor. So, what are some things we've done at Nighthawk to grow it and become stronger as operators?
Yeah, I think at the end of the day, it's really all about the people around, that make up a team. We talked about a team before, and it's so important. And so, we have really tried very hard to attract a strong team. For example, one of the things that we did not do very well early on, we were in this buying and money raising mode, and we bought it and then we closed and we threw it over the fence of the property manager. I'm exaggerating to make a point. Where we didn't really focus on asset management, right? Because, like in the house flipping world, there's a saying that you make the money when you buy, not when you sell. And I would say that's actually pretty true for the house flipping side. For the apartment building side, I don't think it's true at all. You really only make the money if you execute on the business plan and that meets your projections. So we really didn't focus on asset management, and so we hired Daniel Simpson, who's got decades of asset management experience of very large portfolios, and he brings a level of professionalism to the table. I'm a pretty professional person. I'm a pretty smart person, but I'm not really familiar with the ins and outs of what real asset managers and institutions, what they actually do. And I was floored by what he did. And he was asked, well, do you do this? No. Do you do that? No, we don't do that either. And it's just amazing the high level standard that he brought. And so this allowed us to have team members who focus on specific functions and really getting good with those functions, right? So we have asset management is Daniel Simpson. And then Garrett Lynch really focuses on acquisitions. He was doing a bunch of stuff before, and now he's really focused on acquisitions. And obviously, you're working on investor relations. We weren't really paying as much attention to our poor investors as we should have. So now we can shine a light on that. And it's really allowed us to focus more internally on our operations. And so I'm just, I think the key really is the quality of the people that you're able to surround yourself with.
Yeah, I think that team is really important. So what are some good questions, or what are things that are very important if I'm a passive investor that I need to ask every potential operator before I do the deal with them?
Yeah, I think we touched on some of those criteria we talked about before. Who's the team? Who's on that team? Really understanding the individuals on that team. What are their experiences? What have they done? And then also, what is their track record? What kind of deals have they done? What size? How do they perform? Ask questions of how they performed. And then how do they underwrite deals? Really asking questions. Well, how do you underwrite deals? And this is where a little bit of education from a passive investor goes a long way. So you can ask, well, how do you underwrite deals? And you can also ask questions. Well, well, what are you doing to protect my investment? They're very close together, right? And so you can ask an open-ended question and maybe learn the process, but wouldn't it be better to ask the open-ended question than ask really targeted questions that implies that you kind of know what you're talking about, right? So there's very specific levers that the syndicator can pull in their financial models that make a gigantic difference in the resulting returns. And we talked about some. And one is, what is the cap rate you're projecting at exit? Okay, well, that cap rate better not be lower than it is now, because I don't know how much lower they can go. Maybe they can go a little bit lower. I don't know. But they're certainly not going lower. In any model in 5 years that project a lower cap rate, doubtful, right? What are your reserves at closing? How much reserves are you taking out while you're holding the property? In other words, are you building up reserves? And are you projecting that above, or what's called above or below the line? So in other words, are you taking it out of the profit in your projections, or is that something that you're taking out after profit, right? Because if I take it out after profit, my profit's going to be higher on paper. Okay, so a lot of people do that. They just take the profit out at the end and they call it building reserves. Well, okay, but my projection says I'm getting a 12% cash on cash, but that's before I hold back the reserve. So that's not quite right. That's kind of cheating a little bit, right? Things like that. Projections around vacancy rates, especially in a value add deal. In year one, vacancy down from 20% to 5%, and my target rents have been achieved. No, they're not. To reach target rents, you have to actually move people out. They have to either have to kick them out, or they have to move out on their own. Then you have to turn the unit. Then you have to lease it up. And so there's no way you're hitting your target rents in year one. So these are questions that the more sophisticated investor can ask to see, hey, how are you really underwriting deals, and how are you going to be operating this property? To answer that last question, what are you doing to protect my principal and my investment?
Awesome, Michael. Thanks for sharing today. I think it's so important that when people, when we as passive investors put our money, the strength of the operator is just absolutely critical. Because I've seen, weak ones, and it's just, you kind of like, it's a painful experience. So obviously investing with strong operators is really important. So for you listening, just want to thank you, or you watching, taking the time. Thanks for being with us today. I want to encourage you to take a look at a report Michael's put together. It's at themichaelblanc.com/report. And it basically compares the returns and volatility of the stock market to multifamily syndication. I think you'll be really pleased. It's a wonderful report. Also, if you are interested in taking the next step, becoming an investor with us, we have at nighthawkequity.com. You can click the join button and join our investment club, and we can basically let you know about our upcoming deals. So thanks again for taking time. We love doing these videos. We love hearing back from you, what you're getting out of this, and we'll look forward to seeing you on the next video.
Hey, and before you go, make sure you subscribe to my YouTube channel, because we're putting stuff out every single week. Also, check out this special report just for you. It's what's the best investment, the stock market or real estate? It's going to blow your mind. And here's another video for you to check out.